Over the last year, we've seen most dividend stocks suffer in terms of share price performance, but fortunately, nearly all dividend stocks avoided cuts in 2022, with a few rare exceptions. Despite the S&P falling by about 20% last year, which was the worst since the financial crisis, dividend payouts were at an all-time high. In just the S&P 500 alone, companies paid out roughly $565 billion in dividends last year, which was 10% higher than the previous year. It's a great reason why dividend investing is such a good strategy to pursue. If you're living solely off the capital of your investments and aren't using dividends, then you're burning through more of your investments right now. Yet despite everything going on in the stock market and the economy, there has been one stock that's been standing out as a great dividend grower despite declining share prices last year. In fact, for more than 10 years and 10 consecutive quarters, the stocks continue to increase their dividend distributions to shareholders. With a lot of other companies in this same sector having been struggling, they've continued to see year-over-year revenue growth and just great financial metrics across the board. So in today's video, we're going to take a look at this stock, we're going to find out why it's been so successful, and we'll try to determine what the future holds for this dividend stock. So with that being said, let's go ahead and get started. The stock I'm referring to is Arbor Realty Trust, ticker ABR. They're a real estate investment trust that invests in a diversified portfolio of structured finance assets in the multifamily, single-family rental, and commercial real estate markets in the United States. They invest primarily in bridge loans and mezzanine loans, including junior participating interests and first mortgages and preferred and direct equity. They also invest in real estate-related joint ventures, real estate-related notes, and various mortgage-related securities. Arbor Realty offers bridge financing products to borrowers who are seeking short-term capital to be used in the acquisition of properties. Their goal is to be the one-stop shop financing solution for those pursuing multifamily and commercial assets by offering in-house loan servicing. ABR currently trades for $14.44 per share, and they offer a dividend yield of 11.21%. They pay dividends on a quarterly basis, with their last dividend being for 40 cents per share. If we look at their dividend growth chart over the last 10 years, we can see non-stop continuous growth year over year. As mentioned earlier, they've been able to grow their dividends for more than a decade and for every single quarter for the last 10 quarters, with still an impressive amount of growth going on before that. 10 years ago, this stock was paying 12 cents per share in dividends, whereas now it pays 40 cents per share, which is an increase of 233% over the last decade. With everything going on in the economy right now, you'd think they wouldn't be able to keep increasing their payout every quarter, but Arbor Realty's been really resilient in our current market. So let's take a look into why this company's been so successful and try and determine if they'll be able to keep this success going forward. First things first, Arbor Realty is a real estate investment trust, otherwise known as a REIT, which is a company that owns or finances income-producing real estate. For people seeking dividends, they're a great investment because these companies are required to pay out 90% of their earnings back to shareholders in the form of dividends. But it's also important to know that there's two kinds of REITs, which are equity REITs and mortgage REITs. Equity REITs actually own physical properties, collect the rent money from tenants, and then pass off the earnings to shareholders. Mortgage REITs, on the other hand, don't actually own physical properties. They instead either invest in or issue mortgages or other real estate assets. They collect interest and payments from these investments, and then they pass on those earnings to shareholders. Arbor Realty is a mortgage REIT because their portfolio is made up of 99% loans. You might be wondering why I'm speaking so favorably about a mortgage REIT after I just released a video on how the majority of M-REITs are poor investments and should be avoided. In the video, I brought up the fact that the majority of M-REITs have been bad performers because most of them invest in residential mortgage-backed securities. Most of these companies like Armor Residential have been providing horrible returns, whereas only a handful of MBS investing REITs like Dynex Capital have given investors mediocre results. I also stated that M-REITs that don't overly invest in MBSs typically see better returns, with some examples including Rhythm Capital and Ares Commercial Real Estate Corporation. Arbor Realty is another one of those exceptions because they don't invest in mortgage-backed securities, but rather bridge loans, which most M-REITs don't invest in. Bridge loans are short-term loans that are taken out by a person or a company with the goal of being able to secure permanent long-term financing. To give an example of a bridge loan being used, let's say a holding company wants to purchase a new apartment complex. For a variety of different reasons, which might include buying the property very quickly, the company might not have a financing agreement set up. A 1 or 2 year bridge loan would allow them more time to negotiate a better long-term financing option and still be able to take hold of the apartment complex and start earning rental income. Bridge loans are typically much safer compared to other types of loans for a couple of reasons. They're significantly shorter in length, as most bridge loans are only 1 to 2 years long, although they can be as short as 30 days. Secondly, a business would only take out a bridge loan if they were extremely serious about following through on something. The whole reason they take out a bridge loan in the first place is because the company's already done something like purchase a new property, or they've already done something that would be big enough to require a loan. If they ended up defaulting on it, then it would cause a lot of serious issues for them. Bridge loans are also very profitable because they charge very high amounts of interest, so they can be very profitable for companies like Arbor Realty to issue. Let's go ahead and take a look at some of the highlights in their latest investor presentation, which is full of some really good stuff. Under the company review, it starts off with 2 words that I really like to see, which are internally managed. With mortgage REITs and business development companies, you basically have two different kinds of structures, which are internally managed and externally managed companies. If a company is internally managed, that means all of the managing of their investments is done in-house. If it's an externally managed company, it means the company hires an outside firm to manage their investments for them. Companies that are internally managed sometimes, but not always, see better results. This is because it can be really expensive to pay an outside company to manage their own investments. To give an example, Rhythm Capital is an MREIT that recently switched from being externally managed to internally managed, and by doing so, they're estimating that it'll save them up to $65 million a year. But an internally managed company doesn't guarantee it'll be a greater performer. You'll still have to look at the past history to determine if the management team knows what they're doing. Here's another really good line. It says, best in class, highly aligned management team with significant ownership, 12%. This means insiders own approximately 12% of all of their stock shares, which is really high. A stock with a high insider ownership percentage means the board has so much faith in their own performance that they're spending millions of their own money to personally invest in the company. Under recent headlines on the right, it says generated distributable earnings of 56 cents per share in third quarter 2022, which is 16 cents in excess of our current dividend, representing a payout ratio of 71%. And then it says it currently has the lowest payout ratio in the industry. This is also a really amazing metric, which shows that as of right now, the dividend that Arbor Realty is paying is completely covered by a pretty sizable amount. Because REITs are required to pay out so much of their earnings to shareholders in the form of dividends, it's typical to see these types of businesses have really high payout ratios. During especially difficult times, a REIT might even surpass a payout ratio of over 100%, which obviously means that if they don't post better results in the next quarter or two, then the company's probably going to have to cut their dividend, or they might choose to keep it for the time being, but they'll have to burn through what cash they currently have if that's a possibility. A payout ratio of 71% would sound pretty bad for a lot of businesses if this wasn't a REIT, but because this is a REIT, this is actually really good news. If we look at what's on their balance sheet, we can see Arbor currently has a loan portfolio of roughly $15 billion, with 98% of their loans being bridge loans and 92% of their loans going to the multifamily sector. For reference, multifamily housing includes any kind of housing that has more than one unit for residential inhabitants that are contained within one building or several buildings within one complex. So this can include apartments, condos, townhomes, and also multiflex housing like duplex, triplexes, and quadruplex houses. They've issued bridge loans to multifamily housing projects all across the US, and they have an average loan size of $20.2 million. This company's also been benefiting a lot from the current high interest rate environment that we're in right now. For their financial performance, you can see their year-to-date net interest income as of September was already higher than what they were earning in the previous year from their loans. This company's been able to provide year-over-year growth, and at the bottom, you can see the stockholders' 3-year annualized return has been 30% according to this presentation. Overall distributable earnings continue to climb for this company, while most mortgage REITs out there have been feeling a lot of pressure. You can even see in the first quarter of 2022, they had a payout ratio all the way down to 69%, which is exceptional. With so much good news though, we need to ask a really important question, which is what does the future hold for this company? Because Arbor Realty's performance has been tied to the acquisition and construction of multifamily housing, we need to figure out how this market's been doing. According to the National Association of Home Builders, which is a trade association that represents more than 140,000 members involved in home building, remodeling, multifamily construction, and property management, among others, things have been extremely well within this industry. Most of us are probably aware of supply chain issues that were caused by the pandemic, which really slowed down construction sites, and not to mention how high timber prices were just a year ago. But they recently highlighted a study in the multifamily sector of the market. As indicated by the red line in this graph, the demand for multifamily properties has continued to grow for more than 12 years, ever since coming out of the financial crisis. This is despite decreasing demand for new single-family home constructions over the last 6 to 12 months. According to their research, multifamily construction spending increased by 2.4% last November after an increase of 2.4% in October. This was 10.7% over the November of 2021 estimates, largely due to the strong demand for rental apartments. So judging by this report, the demand for multifamily housing is still just as strong as ever. It looks like as housing becomes less attainable for more people, the demand for rentals is going to continue to increase. In summary, because Arbor Realty focuses on the multifamily sector, success for them is going to largely depend on the demand for more of these types of residencies. COVID, supply chain issues, and timber prices obviously didn't slow down this company's growth and increasing demand, and I personally think this is probably going to continue for this company. If the recession we're in does get a whole lot worse, then it will slow things down for this company. But now it seems like most of these financial institutions are now predicting that the recession we're in is going to be more mild than they initially thought. So we're going to have to see if that's going to be true or not. I still think the demand for new complexes is probably still going to remain pretty high for the next couple of years. But as always, be sure to perform your own research and come to your own conclusions before making an investment. With that being said, thank you all so much for watching, and until next time, take care.